You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
I want to get into all the different ways that you can invest in self-storage. All right, and I'm going to just explain what I do. Okay. Now, when I started out, I've been investing in real estate since about 2011 now, like on the upturn of the bubble, is like right on the upturn of the bubbles when I came in, and it was like a gold mine. I mean, and what I did is I wanted to get into real estate investing, so I started flipping houses. And from 2011 to 2015, or 2016, I flipped 100 houses. And that's kind of how I got into real estate investing, was like learning how to flip houses and kind of getting this idea of how this investing works. But now that I'm in storage, I would never do like flipping houses again. Flipping houses is way too much work compared to storage. Storage is also work, but it's not as stressful as flipping houses. Okay. So I had this kind of mindset because I flipped all these houses that the type of facilities I would be open to buying are going to be like horrible ones. All right. So there's not a lot of these anymore. When I got into storage investing, there were a lot of severely mismanaged facilities out there. There's really not a lot of those right now. So although a lot of the severely mismanaged have been, bought up, and they've become income producing property. So the most types of facilities that you hear about are mismanaged facilities and income producing. So I'll put this here. Mismanaged and then income producing. Or they sometimes say cash flowing or, something like this, but income producing. Okay. So a mismanaged facility is not like you can look at a house and you can tell if it's mismanaged. But you can't look at a storage facility and tell if it's mismanaged. The only way that you can know if a facility is mismanaged is by looking at its numbers. Remember, I told you that commercial real estate is really based on the numbers. Now, every once in a while, you can find like a super rundown storage facility. Like we have bought several abandoned storage facilities, and we bought like our very first facility that we ever bought. There was over 1,000 tires like stacked around the whole property. And there was trash everywhere. It was a dumping ground and a storage facility, right? So once in a while you'll find like really bad storage facilities that look like crap, but there's no this just doesn't happen a lot. Like we've done all the facilities that we put offers in, they all look really nice. Okay, so you have to get the numbers. So with a mismanaged facility, all that means is that it is not up to let's say 80 to 90% full, right? Right, for your vacancy. That's what a mismanaged facility is. Okay, so it is not this is but not. All right, so it's less than 80% full. See, so your goal for an income producing property, depending on the location, is going to be between 80 and 90% full. All right, so in a primary market, in a secondary market, and then what we call a tertiary market, which is another word for country, right? It's all going to be based on this. So you're going to have 80% full in the primary market, 85% in the secondary market, and then maybe 90% full in the tertiary. And obviously these numbers change based on the market. Right now, this is where we're at. During COVID, primary market was 90 plus 95% full. I was listening to Marcus and Millichap on a webinar one day, and they were not Marcus and Millichap. Yeah, I think it was Marcus and Millichap. They were doing a webinar on storage. Like they were saying that like the REITs were reporting at like 90 to 95% capacity and had never ever happened. Because like when the REITs, like in these primary markets, they run their numbers, they're running them at 80%. That's what they're running them. If they're 80% full, they're happy. Right? Because in the primary market, there's a lot of turnover, right? People aren't staying for a long amount of time. So like people are just in and out for short periods. And then the further out from the city, right, the further out from these metropolitan areas, the longer the people stay and the higher the occupancy is. Right. So you just know that if you're going to be buying an income producing property, you are going to be looking at how full is this property. Okay, that's like one of the main things. Okay, how full is it? And then, but in a mismanaged facility, it's not full. It's like less than, typically less than a 75% vacancy. We've got abandoned facilities, 25% full, 50% full, 75% full or less, right? And so this kind of like 75% or full, like these types of properties, I would say from like 60 to 80% full, it's kind of like this gray area. Is it a mismanaged facility or is it an income producing property? Right? It's kind of this gray area. And so you want to just keep that in mind. There's this area where it's like, we find this is what's happening because of COVID, is we are finding properties that are maybe 60% full or 70 or 80% full. They're producing income, right? But they're not producing the amount of income that it should be producing. Okay. Now, how much income should a property be producing? Right? How do you figure out how much income a property should be producing? So what you do is you get your unit mix, right? You have 10 by 10s, 10 by 20s, 10 by 30s. All right, whatever sizes it is, okay? Whatever sizes. And then you start looking at your competitive analysis. Okay? And the competitive analysis is what's going to show you what your prices should be. What is the market calling for in this area? And are they below market price? Are they at market price? Or is there a way to increase your prices? Okay. And then when you think of prices, you're going to think of in terms of like, what's your standard rate? Right. And then what's your website rate? And then what's like if they call in? What's that rate? And you could have the same rate across the board. You're like, no matter what, my rate is $65 for a 10 by 10. That's it. All right. And then, or you could call in, and it really depends on like if they go, like for us, if they go through our website, they're going to get a different price as if they call in, right? Or like we have like a marketing price. So we do like, ads on Google. We do all this different stuff to get promos and to get tenants in and stuff. And that could be a different price than like if they call in or if they're going through their website. Okay. So you just have to know that when you're talking to owners, like this is what you're going to have to figure out, like across the board, like is your prices the same or do you have different prices based on when somebody calls in? Okay. And so then you gather all this information from the owner, right? This is from the owner. And then you also gather that same information from the competitors. And then you look apples to apples. There's no reason if your facility has like 10 by 10s and 10 by 20s, and you look at a competitor and it's got like 5 by 5s and 5 by 10s, there's no reason for you to look at that facility. That is not competition because that's different sizes, okay? So you want to find competitors that are within a certain mile radius, and you want to like see what they're charging. And typically it's going to be anywhere from, depending on the location, it'll be anywhere from like a 1 mile radius to a 3-mile radius, to a 5-mile radius, and maybe even up to a 10 if it's like super country. Okay. Okay, so you're looking at all the storage facilities in the area, you're looking at what they're charging, and then you're deciding on what rate you're going to be charging. Once you figure out what rate you're going to be charging, you are going to be able to find out if that facility is a mismanaged facility or an income producing property. Okay, so we have found like we see all different types of facilities out there, but right now there are a lot of facilities that are less than 75% full, right? But they are at, they're at like they have a lot of prices that are really low, right? So you could raise the rates. Or they're at industry standard. Like all the competitors all have the same price, but for some reason, they're only 75% full. And so just knowing what the competitors are going to be able to charge and what you're charging and looking at that and really just reevaluating the industry gives you a very good idea of like how you're going to be able to run your facility. So for instance, if I find a facility that's 75% full and it's the same price as everybody else in the industry, then my question is like, can I raise rates? Am I going to be able to fill this property, or does it really, or is that area oversaturated? Is 75% where the market should be for that area? Right. So knowing these two situations here and understanding these two situations are going to help you determine what kind of an offer you're going to put in. So mismanaged facilities and income producing properties. Income producing properties, it's cash flowing, right? But is it at the vacancy it should be? Okay, it's cash flowing plus vacancy. What are the questions here? Now, it's not full here, not full, but it's not full, right? And it's not at the prices it should be. Okay, so that's kind of the difference between an income producing property and a mismanaged facility. Now, with a mismanaged facility, just so you know, mismanaged facilities are very hard to fund. Of all of the facilities out there, like this is the hardest ones to fund. And I see this over and over and over in my students. Is that they will find a property that is like 75% full, but it's not at the rates it should be. It's not producing what it should be. And the banks are not like funding these types of deals. And especially in a deal that's like $1 million or less, right? Because if you have an income producing property means that the owner can show you the P&L, the balance sheet, tax returns. They can show you your occupancy. They can show you the management summary. Anything that you need, they can show this all to you, right? And then you take all that information to the bank. Just because you have that information doesn't mean that the bank is going to fund it, right? Because there's like a high down payment and then there's an interest rate that's super high. And so maybe the numbers don't work. And we're seeing this over and over again, is that there are a plethora of income producing properties. They were mismanaged facilities. Like, in the last couple of years, all these mismanaged facilities got snatched up. And the owners got them to like 50, 60, 70% full. They're ready to sell. But right now, the banks will not fund them, right? Because the numbers are so tight because of the finance. And so you have to be aware of that as well too, is that that's happening in the industry and it will be like that for quite a while. So income producing property, so mismanaged facilities, banks will not fund. Income producing properties, banks will fund if there's a spread, if there's cash flow, right? And so there's a lot of factors that go into determining if you're going to be able to buy one or the other. If you find a mismanaged facility that's 25% full or 50% full, and the owner's just like not managing it properly, then what you're going to have to do is you're going to have to find your own funding. You're going to have to get out there. You're going to pay cash for it, right? You're going to have to pay cash, right? Or you're going to have to do some sort of creative deal structure. A lot of times this will be owner financing, but the owner financing is when the seller is the bank, and the seller is open to doing that. The seller, so you say, look, the bank's not going to finance this. If you finance it, I'll buy it, but the bank's not going to finance it because they're saying that the numbers are not correct. So we do a lot of creative deal structures on our deals. Just in the last a couple of months, several students closing on owner finance deals. And the deal analyzer, my deal analyzer, teaches you and shows you how to run the numbers so you can make these types of offers. Because if you're only making a cash offer or like an offer that where you can go and get the bank financing, what's happening is that those numbers are not working. So income producing properties where like you're saying, it's making $100,000, but the bank only wants you to pay 700 grand or maybe 800 grand. And the owner's not going to sell it for 800 grand. They want $1 million. Okay. So it's like, how can we work this deal? How can we close this deal? And that's where the creative deal structures come in. So that's the difference between the mismanaged and the income producing properties. Right? Mismanaged is very, very hard to fund. You have to get out there and raise the money. All of the 16 facilities that I've bought myself are all mismanaged facilities. So that means that I had to go out and raise the money to buy every single one of them. And and that's a lot of work just in itself. I think of in terms of fundraising, that is a lot of work in itself, even if it's 200,000 or 500,000 or $2 million, right? So on the income producing, if there's enough spread, there's a bank out there that will fund these deals. Now, what we're seeing right now in the market is that these types of deals, which are mismanaged facilities, you are going to have to get out there and you're going to have to raise the money. The good thing is that people are trying to figure out where to put their money right now. So if you are okay with asking people for money, just say, look, I want to buy this storage facility. I don't have enough money to buy this. Would you be interested in partnering with me on this deal? I think it's a good deal. And a lot of people are really trying to figure out how to place their money. So don't be shied away from a mismanaged facility. Just know that if you are not raising money, you will not be able to find these deals. Now, these deals right here, this mismanaged facilities, they have a lot of upside. That's why I love them. Okay, it's a lot of work. It's a lot of work for about 18 months to 2 years. 2 years of owning that property. It's like blood, sweat, and tears. Okay. And then after that, you have all this upside. And then you get to sell it, and there's like this huge spread, so you get the money on the back. And that's kind of the most important thing about storage, is that there's not a lot of cash flow. There's really not. It was like people say, oh, I want to quit my day job. And it's like, it just takes a lot of properties to quit your day job. Right? If you're making 5 or 10 grand a month, then, that's a lot of money net. So it's like a lot of net profit right there that you're going to have to earn. But what's really good about storage is the back end appreciation. And on a mismanaged facility, we don't have a lot of, we don't make a lot of money on our properties because we're always trying to get them leased up and fixed up and get them cleaned up and stuff. But once we do that, then we know that there's like a huge appreciation. So for instance, like we bought a facility in Georgia. It was a fire damaged facility. And a tenant was living in that facility, and they ended up burning the facility down. And so the owners basically and the insurance didn't pay the owner. So the owner was just stuck. He had no money to fix the facility up. So he ended up selling it to us. It was a 20,000 square foot facility on 6 acres. So it was a very nice property in a very good location in Georgia. And he ended up selling that property to us for $350,000. We went in there and renovated, and we spent several $100,000 renovating it and fixing it up. We're in the process of leasing it up, and just the facility itself will be able to sell when it's leased up at 80% at $2 million. So we will make like $1.5 million on that facility, but it was a lot of work on the front end. And how did we pay for that? There's no bank that's going to pay for this. There's no bank that's going to fund that deal. So we had to go out and raise the money to purchase the facility. We had to go out and raise the money to do the renovations. And that's how we bought the deal. Okay. So, and then on the income producing side, right? And then so for this right here, you just have to know that you're going to need properties that have a lot of spread right now. Banks are being super conservative and they don't want to lend on risky endeavors. So because of that, it's very hard for $1 million or less properties to get finance. It's not impossible. You get a really good deal on it, you get a good price, then the banks are open to it, right? Just as long as there's a spread. And that spread is called the debt service ratio, is what it's called. But if there's a spread, then the banks will be open to it. We are typically not seeing a lot of spread on $1 million or less properties. And we're really only seeing very little spread on $1 million to $2 million properties right now. Where you do see a lot of spread is obviously in the bigger deals. I am right now saying, I used to say the sweet spot was like 1 to 2 million, but I feel like the sweet spot right now is like a $2 to $3 million property. I had a student that just bought a facility for $2.5 million. He got an SBA loan on it, so he only had to put 10% down. It was $250,000. And he got like 8% interest. It was a fixed rate. So it was a really good deal. He got it appraised. It was appraised at $4.5 million. And because of that appraisal, it was appraised at $4.5 million. The banks were okay with lending the money to him. And that happens a lot in like a $2 million or a $3 million property. Right now, you might not be able to get an SBA loan on that deal. You might have to do a conventional deal. Conventional deals are 30% down. So you just have to keep that in mind. The SBA is kind of a little bit harder right now to get, but he had really good credit and he had done like a lot of he had done some real estate transactions and he was an accountant. He had money and stuff. So the bank was okay with lending him money. But that spread I'm seeing is $2 million plus. Right, so just giving you an idea of kind of how the industry is working right now. Okay. So that is income producing versus mismanaged. Right. That's the bulk. That's what you're going to hear about. What you're thinking about is these two types of deals when you think of storage investing. That's kind of an overview between the difference between income producing and mismanaged. Now let's talk about new construction, right, versus conversions. Okay, new construction versus conversions. Okay, so we bought a conversion last year, and an owner had a building. He converted it. He had a building. He converted it into storage. There's 150 doors, and then there's some commercial space. And so we actually have a climate controlled. A conversion is like a climate controlled facility. Okay. Now, new construction is from the ground up, all right? So I'm sure there's somebody listening to me right now that's like, I have a piece of land and I think it would be perfect for a storage facility, okay? And if you're that person, you can say yes in the chat because I know there's somebody listening to me right now. But, and so this is where you're going to have to buy the land. You don't own it already. And you're going to have to, get all the zoning done. Make sure it's zoned property. Get the permitting done. You're going to have to, then you're going to have to build it. All right, let's just escape. Let's do the, what's it called? The grading. And then you're going to have to do the retention pond. Don't forget about that. The big thing right now. And then you're going to have to do the foundation. And then you're going to have to build it. And then, guess what? You're going to have to lease it up. Right? This phase right here is like 18 to 24 months. Okay? Just that phase right there. All this phase right here is also going to be around 18 to 24 months. I'd say 18 to 36 months. Okay. It takes a long time to build a storage facility. It takes a long time to go out there, look for the land, get it rezoned, make sure you have to go, if you have to go to neighborhood associations or whatever it is. So that's new construction. Now, right now, it's a little bit harder to do new construction. And the question is, can I make money from new construction? The only, like, I see a lot of people going out and building, and then they're like trying to sell it. And they're trying to sell it at the price it was supposed to be made if it was leased up. It's not leased up. So I see a lot of people right here kind of like doing all this and then trying to sell the property without it being leased up. So, which is possible, all right? Which is so you can do that. You can get it all the way to here, and then you can be like, nah, I don't want to be a storage facility owner. I'm just gonna sell, excuse me, I'm just gonna sell it like as is. And then the lease up is where like you're gonna have to manage this thing, get out there and like, do all the marketing and everything you gotta do, which takes a lot of work and effort. And I see, both scenarios. I see this. And then on top of that, what I want to write here is what's called entitlements, right? Which is another way of doing it. Okay. And entitlements is getting everything ready, getting it ready up to permitting. So all of this right here. So this is like the zoning, the land, buy land, get it zoned, it goes to permitting. Get it permitted. All this is included. Okay. That's called entitlements. So there's several different ways for you to do new construction. You could just do the first part, pre-development. You could do the second part, you could do the development part, or you could do the actual ownership part. Or you could do all of them together. You can do all of it, but you can separate that out. So I have a student that she only does entitlements. That's it. Like that's her thing. Like she gets everything ready, and then she just lists it on Crexy, and then some big player will come in and just buy everything and just be ready to build day one. That's how it works, right? And that's kind of her thing. And then I have several students that right now are like building new construction, and we actually have kind of sort of, we renovated that facility that was burnt down. And then now we're in the process of like leasing up. So it's kind of sort of the same thing because that thing really was more like new construction, what it was. And then you have the conversion. Okay. And the conversions is where you're going out and buying like, a Kmart or something like this. You're converting it into storage. Now, all of this right here, this zoning, permitting, right? And then actually building it, the building is all the same. It's all included into this. So you still have to do all that in order to do a conversion, or you can just buy the conversion at the end, right? And then you can do the lease up. So we did that. We bought the conversion, and now we're leasing it up. Somebody went through the process of doing all this in order to build that conversion and build that out. Okay. And you can do both. You can do the building if you're that type of person, or you can also own it and do it as well. Now, these all right here, you have to have a strong stomach. All right, you gotta have a strong stomach because this takes years. This whole process could take years. This takes years. Even this takes years. Okay, and also this costs quite a bit of money. Okay, the entitlements, like the zoning and going through the process, it could cost anywhere depending on where it's at, $30,000 to $200,000, depending on what type of deal it is. And the same thing here, and even that's not even including the build price. Okay. So just know that and it takes forever. So you just have to go through the process. You just have to have a strong stomach. I built houses before and it was horrible. I am not this type of person. Okay, this is not me. But some people love this. All right. So I just want to put this out there that this is available inside of the storage world if you are this person. I have many students that are contractors. Like that is their mindset. And that is like, they're just like, I'm okay with like building it and owning it. Like I can do the whole thing because I've done that before. And that's your thing, right? Okay. We got building, we've got new construction conversions, we've got mismanaged facilities and income producing properties. Okay. Now we can also get into wholesaling. Okay. So wholesaling is like you are the middle person, right? Between the owner and the buyer. Okay, this is the owner of the facility. This is you, and this is the buyer, right? And you are going to exchange a contract, right? That like gives you permission to market that property, right? It's an assignable contract, is what it is. So you are the middle person between the buyer and the owner. So your job as the wholesaler is to go out and find owners that want to sell their properties. You put it under contract, and then you go out and once you get it under contract, you have to pay your earnest money. Right? You have to pay the earnest money because you still have to have a little bit of money to do this. And then you go out and you find the buyer, and you see wholesalers and all the Facebook groups and stuff. This typically works with smaller facilities. You don't see a lot of bigger facilities. Bigger facilities, what you do is like you can get a cut in the deal. This is what I do. I'll wholesale a deal, and I'll just be like, look, you can have this deal, but I want like 10%. Right? And I'll do that. And that's the same kind of concept. And you can do that with the bigger facilities, and then you can exchange money with the smaller facilities. So let's just say you get it under contract for $100,000, and you can sell it to this guy for $150K. Okay, and then that means in the middle you get the $50K. That's your price. That's how it is. That's how wholesaling works. Just as long as you have the contracts, you make sure it's legal in your state. Some states it's not legal. You make sure that you understand this process. I go over this process in the coaching program and in my course. All right. So if you want to understand, and I am in the process of doing a wholesaling course right now to be ready maybe in the next couple months. Taking forever. But, so just know if you want to learn how to do this now, just get the course. It's all in there. Everything that you're learning in the course is exactly what you need to know in order to wholesale. Okay, that's what it is. All right. The last way that you can invest in self-storage, the last way. This is my most favorite way. Okay, lending. Right, lending. All right, why do the work? Why do the work? Just like hand your money over, lend the money, and let somebody else do the work. Okay, so I have I have a lot of investors. And, but I have one, my very first investor that I started investing with 2011 maybe, or 2012. So it's must have been 10, 11 years ago. And he's made over $1 million off of me just by lending me money to do all the things that I'm doing. Okay, he's done nothing. In fact, of all the properties that we've worked on, he's seen 2. My very first rehab that we did together, he came out and he saw it with me. And my very first storage facility, he came out and he saw it. And that's it. That's it. And he's made $1 million off of it. Okay. So if you have money to lend, I highly recommend thinking and considering about this, either through your retirement account or actually with cash, whatever you have, you can lend the money out. You can partner on the deal or you can have debt. And it really depends on your risk level. Maybe it's the first time you're a little bit risky, you're more risk sensitive, but if you can do that, I highly recommend looking into private lending or partnering on deals, because then somebody else can do the work. This is where we're at right now. We are not going to be buying any more storage facilities. I'm partnering with my students and lending my money out. And ultimately, as an investor, that should be your goal. I want my money to just make money and not us have to run around like crazy people trying to make money. Okay, so lending is one of the factors that you can do in any investment, in any real estate investment out there. But in storage, it's just, it's just so good. Okay, so I wanted to put that out there. That's one of the niches. So you have lending, wholesaling, entitlements, new construction, conversions, and you have mismanaged facilities and income producing properties. So as of right now, when you're looking through all this, tell me in the chat which of these are the ones that you're interested in doing. I would love to hear, or post it out in our Facebook group and let everybody know I listened to Stacy's session and I'm really interested in doing conversions and new construction or whatever it is. So post in the chat so I can know what you're interested in. And anything that you learned today or any questions you can post in the chat. And then also, just a quick reminder, if you want to learn more about what I'm talking about, go to stacyrossetti.com, get the course, get the deal analyzer, come to this training and be active in our group. And that will help you. Okay, that will help you to get to take action. Obviously, that is what's going to get you to where, into this industry. Okay, good. I see wholesaling. I see mismanaged facilities. I see a question, the hierarchy of pricing, standard website, call in and market. Generally, which level gets the lowest pricing and which is the spread? On the website, I would say like any marketing that we do, that's going to be the lowest. Like we're doing a promo right now, which is like 50% off the first 3 months. So if you're coming in through a Google ad, that's going to be a different pricing than like if you come on our website or if you call in. If you call in, for us, using the 50% off for the first 3 months is the negotiation. So we call in and we tell them what our normal standard prices are. If they are for that, awesome, we book up. If they're not for that, then we push to 50% off. Right. So that's why our numbers are all different. And then on top of that, Eric, then remember, I know you remember this because you come to all my sessions, but you also have to remember that there's what's called, revenue management and dynamic pricing. Right? So this is where I only have 20 units units available right now. This is the price. I have 15 units available. This is the price. I have 10. I have 5. I have 1 unit available. This is the price. That 1 unit is way more expensive than the 20 that we're trying to get leased up. Okay? And then you can also dynamic pricing is all percentages. You can increase to a flat rate or you can increase by percentage, depending on what your occupancy on that unit size is. Okay, so when you start looking at prices, like if you see an owner and they have the same price for all the units and that's it, like they do not understand these concepts. And they're missing out on a lot of revenue. Right? And so you as the owner, you need to understand these concepts. Okay. And so that's kind of why I'm saying, you've got to understand there's a lot of different prices out there right now. Sometimes there's not. Sometimes it's just I don't know what I'm doing and everything's just $55. And then sometimes like us, every unit size is different across the board. When you came in, how much we have, if your promos we have, whatever it is. It's hard to determine what that price per square foot would be because you have to determine what the average unit size of that unit is. So the average unit price of that unit is based off all the different pricing that we have, which makes your deal analysis even more convoluted. Good. I see a lot of mismanaged. I see wholesaling. I see a lot of good. Okay, so hopefully I piqued your interest today. And hopefully I'll see you back again. And, I'm here to teach you how to get started. So just let me know if you have any other questions. And I appreciate you guys coming on, okay?
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.